There is a deep financial fracture opening up across the state of Florida right now. And it is concentrated inside 10 specific coastal cities where the real estate numbers have officially turned. The national media loves to show you footage of a booming housing market with brand new master plan subdivisions filling up with cash buyers. They want you to believe that the Sunshine State is an untouchable tax haven of endless wealth. But behind those shiny builder flags and polished corporate brochures, a brutal financial trap has just snapped shut. Private insurance giants are quietly pulling the plug on entire zip codes, leaving millions of middle-class families exposed. Their homes aren't just losing value, they are becoming completely uninsurable and unsellable. And this is where things get ugly. Take a ride down the manicured streets of Cape Coral, Fort Myers, or Naples. From the outside, it looks like an absolute paradise, designed for the perfect American retirement. But on the ground, homeowners are opening their mailboxes in 2026 to find annual carrying costs that resemble a second mortgage. We are talking about regular families receiving renewals for $12,000 a year just to insure a standard single-family home. The real estate headlines keep screaming about price resilience, but they hide the reality of completed new builds sitting quiet and empty because the math no longer adds up for everyday buyers. When the baseline insurance premium costs more than your property tax and interest combined, your property ceases to be an asset. It becomes a permanent liability. Would you be willing to sacrifice $12,000 of your hard-earned savings every single year just to hold a piece of paper that keeps you legal? Of course, not every county across the state is absorbing this exact level of pressure, and landlocked areas like Ocala are managing to keep their inventory moving for now. But if your dream involved living anywhere within driving distance of the coast, the financial dead zone is officially spreading. Most people blame local home insurance companies for being greedy when they see their premiums double within a single fiscal cycle. But the real economic warfare is being driven by the global capital markets in New York, London, and Zurich. Local domestic insurers don't actually carry the ultimate risk for your property. They buy their own secondary protection from massive international cartels known as reinsurers. In 2026, Wall Street investment funds restricted the supply of capital moving into the Florida market, driving global reinsurance rates up by 35%. This corporate squeeze forced smaller regional insurers into immediate insolvency, while the household names simply packed their bags and walked away to protect their corporate stock prices. The mainstream narrative frames this retreat as a natural response to changing weather patterns and climate statistics. But the cold reality is a pure corporate calculation to abandon the independent American middle class in order to secure institutional profit lines. Do you think it is fair for multi-billion-dollar financial syndicates to collect your cash for 30 years and then erase your coverage the moment the risk becomes real? Naturally, from a purely capitalistic perspective, an insurance firm cannot operate at a continuous loss without destroying its own shareholder value. But this calculated exit has triggered a secondary crisis within the lending institution. This is where the financial trap locks you in. A lot of desperate homeowners think, if insurance is too expensive, I'll just drop the policy and take my chances with luck. But if your property has a mortgage, the system will never allow you to step away from the table. Over 60% of residential structures across these 10 crashing cities are tied to a standard 30-year bank loan. Under federal lending regulations, maintaining active hazard insurance is a non-negotiable term of the contract. The moment your private policy is canceled and you fail to find a replacement, the bank's automated compliance algorithms deploy a penalty called force-placed insurance. They buy a temporary policy from their own corporate partners. It costs up to 4 times more than a standard premium, offers zero personal liability protection for your family, and the cost is slapped directly onto your monthly mortgage statement. If your fixed income cannot absorb a sudden $2,000 jump in your housing overhead, the bank initiates immediate foreclosure and repossesses your home. Mainstream real estate gurus always promoted a 30-year mortgage as the safest path to middle-class stability, but right now, it is a legal trap that strips away your net worth overnight. How long could your family budget survive if your bank suddenly doubled your monthly housing payment without your consent? Granted, wealthy cash buyers who own their luxury properties outright are completely immune to this banking leverage and can go bare if they choose. But for the working class living paycheck to paycheck, this carrying pressure is driving an unprecedented explosion in condo fees. If you thought you could escape this entire crisis by downsizing into a beautiful oceanfront condo in Tampa or Fort Lauderdale, you walked straight into a far more aggressive trap. Under intense new structural safety mandates, building associations across coastal Florida are hitting a legal wall. Private insurance providers are refusing to sign master policies for high-density buildings unless the condo boards immediately fund millions in cash reserves for repairs. To avoid corporate fines, these associations are dropping unexpected bills called special assessments straight down to individual unit owners. Seniors living on a limited, fixed Social Security pension are opening their mail to find surprise invoices demanding $40,000, due in full within 90 days. This is on top of their monthly HOA maintenance fees doubling or tripling just to keep up with the building's corporate premium hikes. The high-rises look magnificent and secure from the outside, but inside, everyday working families are in an absolute panic, as these forced carrying costs exceed their entire monthly retirement income. What would you do if your building association gave you a 90-day ultimatum to hand over $40,000 or face immediate forfeiture of your property? To be fair, modernized luxury complexes built within the last 5 years feature high-efficiency engineering that keeps baseline operational costs manageable for residents. But for the traditional brick-and-frame buildings that house the true middle class, this fee explosion is a financial death sentence. This process leads directly to the core of the crisis. Your home becomes a completely unsellable asset. When you try to list your home on Zillow or Redfin to escape the rising bills, the market reaction across these 10 cities is dead cold. Buyers in 2026 are highly educated. The first document they demand isn't the floor plan, it's the historical insurance premium sheet. The moment a potential buyer realizes that a standard single-family home carries a $10,000 annual premium, they walk away from the deal. Even if you find a buyer willing to take the gamble, their traditional mortgage lender will automatically deny the loan application because the property cannot secure affordable hazard coverage. The transaction freezes completely. You cannot afford to keep the asset, and the financial system prevents you from selling it to an ordinary consumer. The traditional real estate narrative always claimed that coastal land is a guaranteed wealth generator because they aren't making any more of it. But a property that cannot be protected or financed has a real-world transactional value of 0 to an independent family. If a coastal property was marked down by 40%, would you take the risk of buying it knowing the carrying fees attached to the title? Obviously, massive institutional investment pools and private equity sharks are waiting in the wings, happy to acquire these frozen properties for pennies on the dollar using pure corporate cash. But for a middle-class family whose entire net worth is tied up in their home equity, this freeze is an absolute wipeout of generational wealth. Florida built its entire economic engine on the promise of an affordable, tax-friendly paradise for the working class. But that promise is officially dead. We are now witnessing the birth of a quiet, steady exodus of regular families packing up their lives and fleeing the coastal zones. Recent internal data from the Census Bureau is beginning to track a clear migration wave of middle-aged Americans leaving Florida for Georgia, Alabama, or the Carolinas. They aren't moving because of the weather. They are leaving because they are being priced out by fixed carrying costs. The state politicians love to boast about the ultra-wealthy executives moving their hedge funds to Miami, but they completely ignore the silent exit of the working class, teachers, and retirees who can no longer afford to hold property here. A region that prices out its own core population cannot sustain its real estate values over the long term. Of course, population shifts are a normal rebalancing mechanism within a hyperinflated market, and Florida's broader economy still shows job creation in landlocked sectors. Yet, this steady flight of independent middle-class capital is leaving a deep scar on the future of the local housing market. If you are watching this from Texas, California, or the Midwest, and you think this coastal insurance meltdown is just a localized Florida issue, you are making a dangerous mistake. This is the exact blueprint for an unaffordable America. The identical corporate strategies and automated risk algorithms are being deployed right now inside the wildfire zones of California, the hail corridors of Texas, and the floodplains of Louisiana. The global banking and insurance networks are quietly rewriting the terms of property ownership across the United States, converting residential real estate into a high-yielding corporate commodity. The policymakers keep releasing statements claiming the national housing market remains fundamentally stable. But the data on the ground proves that the core foundation of middle-class wealth is fracturing under the surface. Take a close look at your own property insurance renewals and municipal tax statements this month. Are you starting to see the early warning signs of the squeeze appearing in your hometown? Share your local numbers and your experiences in the comments below so we can track how fast this structural shift is moving across the nation. The United States has an incredibly resilient financial system, and grassroots legal challenges may eventually force regulators to step in and limit how corporate capital manages residential risk. But before those macro solutions arrive at your doorstep, individual homeowners must recognize the reality of the trap before the system locks them in permanently. Subscribe to stay informed on these hidden economic shifts, protect your wealth, and we will see you in the next report.